And so the sell-off will feel way worse, I think, in 2025 or 2026 than it did in 08, 09, because you've got a lot more people, gambling in the stock market now, right? This is more like a casino-like environment than an investing environment to me.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up, and we're fortunate to have with us John Feneck. John began his career in 1992 as an equity analyst for Merrill Lynch. From 93 to 2019, he was a senior executive for both Merrill Lynch funds and Morgan Chase funds. John shares his expertise regularly through featured articles and interviews with well-known industry resources such as Sprott, Kitco, and others. And in September of 2019, John started Feneck Consulting Group based on demand from commodity companies, especially those in the metals and mining sector. John, thank you so much for joining us today.
My pleasure, Gary. Nice to be here for the first time.
Well, let's begin with a look back on 2024. From an economic and market perspective, what surprised and shocked you? What fell right in line with expectations? And what are you expecting moving into 2025?
In no particular order, copper surprised me again in that it could not produce return, yet everyone and their mother loves copper, right? All the big banks, Goldman Sachs, Morgan Stanley, have all been talking about higher copper prices now for 2 years, yet we haven't seen anything. Now, it's been very tradable, right? Which is something that we can talk about either today or on another podcast, but we will trade, right? If you look at copper in 2024 and you bought and held for 1 year, meaning Jan 1 to December 31, you made hardly any money. The previous year, you actually lost money. So if you traded it, you would have made a lot of money, right? Because it went from $5 down to $4, and there was a lot of tradable opportunities in there, both for the equities and for the metal. But we are not of the mindset that metals and mining is a buy and hold and cross your fingers and put it away for 5 years. You have to be looking at this stuff on at least a monthly basis because things change, and you have to be an active person, or else this sector is probably not for you as an investor. What did not surprise me is gold. Gold had a breakout year that was due because we saw technically last year it holding certain levels, right? We saw it break above 1575 a couple of years ago, which was former resistance. We then saw 1900 hold last year for months and months, like never closed above 1900 an ounce ever for like 5 months plus in a row. That's very good technically. And then it broke above that big round number 2000. And now we see 2300 as support. Really, I mean, it touched around 2500 after the election, November 5th, but it's been extremely resilient, as I'm sure you can agree. And, what's really interesting, what really surprised me from last year is that gold equities have done virtually nothing. I mean, you have to really look for winners. Agnico was a winner, AEM. Alamos was a winner, AGI, but there's many stories that surprised people, like Newmont, NEM. Newmont is the largest holding in GDX, which is the largest product in the mining space with over $15 billion in it, right? So when you're the biggest holding in the biggest ETF and you're underperforming, it's a problem for the sector in general.
Major, yes. So John, the dollar index, it's been super strong. And yesterday crossed over 109. I didn't see what it was today. If the Dixie gets much stronger, things could start, as they say, blowing up around the world. I did hear that the magic number's around 111 for Mexico, 112 for another country, 113 for Japan, et cetera. That said, if you had to make the case for it, why must the dollar weaken? And is that what you expect to happen in 2025?
So we are independent thinkers at Feneck Consulting. We haven't been following the herd on the dollar, getting blown up like so many of my peers have said for the last 1, 2, 3, 4, 5 years, you name it. Like we've just said, look, there's periods of time since the 1970s, if you go back and look at history, where the dollar can run alongside gold. That's what's happening. And so I'm not one of these, people that are going to tell you or your listeners, hey, the dollar's going down 30%. Here's why. it's just not happened yet. We deal in facts. That's how you make money in any sector. I think you deal in facts. You don't deal in what ifs. I mean, yes, there's an element to black swan events and World War III and the different things that are on the table right now. But I don't wake up every morning investing like the dollar is going to go to X price, right? Like I look at the action, the tape, so to speak, and I make decisions based on what the market's telling me. So I'm not in the camp that the dollar has to crater for gold and silver to do well. The market is telling you that there's two camps, Gary. There's a person like myself that believes that safety has a place in a portfolio. That would be the dollar. That would be gold, right? Silver. Then there's the other contingent that is like, hey, I'm going to put my money into the market like it's a casino. And that's not me, right? Like I'm not buying NVIDIA at all-time highs. I'm not buying tech as a sector in general. I think that most of the hot money is still in that sector. And I think a lot of the upside gains have been made. And in 2025, we're going to see more volatility.
I do have some questions on the market there in general and NVIDIA, but I'll get to that in a moment. Recently, outgoing U.S. Treasury Secretary Janet Yellen, she said that on January 14th, the Treasury is going to run out of money. And according to her comments last week, extraordinary measures will be necessary. What kind of measures would you expect to see taken, and what type of impacts will these extraordinary measures have?
So just historically, every time we hear about these measures having to be taken place, if you look at recent history, 1, 3, 5 years, something always happens where someone steps in and fixes it, right? Like this is the truth. Again, we're dealing in facts. And it's a good question. However, I don't think anyone knows what's happening after January 20th right now. I mean, there is a lot on the table with Trump coming into office, and I think he's going to surprise people. That's why we were cashing up in September, October pre-election to make sure that we didn't get surprised. And we did get a surprise in the mining sector November 5th to December 31st. It was pretty brutal price action. I mean, even producers that are larger cap were down 30 to 40% in less than 2 months, right? That's brutal. So you have to know when to step aside in markets right now. If you're a money manager out there, if you got them behind closed doors, I bet a lot of big money managers will tell you they're really nervous going into January 20th and into 2025 in general because they just don't know what to expect, and markets don't like uncertainty.
So uncertainty is what you're calling for, and volatility in 2025.
Versus like the same levels that we've seen in years like 23 and 24, where it was just basically a party, right? I mean, no one can disagree that the NASDAQ, the S&P enjoyed amazing years, right? Good for you if you've participated in that. But I think it's prudent to look at your 401k from March of 09 to now and realize that you're not the best investor. You got lucky part of the time, and you have to be able to take some of that money off the table right now and rotate it into things like Newmont that are going to produce tremendous free cash flow as one of the largest, gold stocks out there that are shedding assets, that are cleaning up the balance sheet, that are trading at under a 30 RSI of relative strength index. It's like crazy, and so I don't think we're there yet. I think we're still in this kind of party mode, but I'm just saying that you need to be cognizant as an investor that January 20th and beyond is going to be different than what we saw over the last number of years.
Yeah, and I think it's challenging because people have been so disappointed. They were expecting with the major cash flow that Newmont was earning that the stock was going to pop, and then it didn't. And so I think they're going to have to get over that as well. John, interest payments on the federal debt pile has jumped from $225 billion in 2020 to $1 trillion in 2024, and based on the current debt path, the interest rates and the deficit run rate, it's projected to jump to 1.5 trillion this year in 2025 and then 2.1 trillion in 2026. How sustainable is this? Do you think it's more likely that the Fed will take some pressure off of this by lowering rates much deeper, than they've been saying they would, despite the rhetoric that they definitely wouldn't do that?
Yeah, so that's a great question. I don't know the answer. I'm never going to tell you and your listeners something that if I don't know the answer, I just don't know the answer. I don't think many people really know the answer there. I know that the pattern is headed up, of course, in terms of, clipping higher amounts of debt, and that's going to be problematic for our economy. However, like, I look at the Fed and I look at what the Fed is saying and what the Fed said prior, and try to, like most people, read the tea leaves to understand where things are headed. I think the
Yeah.
Fed is in a corner. They've been saying, four cuts all fall. And now December 18th, they say, sorry, just kidding, two cuts. I don't believe that for a minute. I think that Trump will come in and force situations that people can't foresee happening right now with the Fed, just as he did with the Supreme Court. No one thought that would, end up the way it did under his
That's a good
direction, but
point.
it did. And so I think the Fed is going to have more members that are Trump-like thinking in terms of, lower rates for this year. Because look, Trump has an agenda. Trump is a real estate mogul. He needs lower rates. And I think that's, despite what Powell has said vehemently in November and December, that there's absolutely no way Trump can get involved, I disagree, and I think that the Fed is going to play ball, and I don't know what that looks like. I just know that we're going to have some type of comeuppance in 2025, and that will be positive for gold and silver in general, because as precious metals, again, the metals love uncertainty and volatility, and I think we're just going to see more of that in general.
I appreciate that take. If you look at the 5 most famous stock market crashes, the Wall Street crash of 1929, the 1987 Black Monday, the 2000 dot-com bubble burst, the 2008-09 global financial crisis, and the pandemic crash of 2020, every single one occurred when the stock market was at or near its all-time high. The S&P 500 recently crossed 6,000, the highest it's ever been in stock market history. How overvalued are stocks right now, or are they not? And what is your analysis pointing to for the market moving forward this year?
We are very overvalued as a broad market. I will caution people that want to get short that markets tend to head higher than you think and run longer than you think. And they also stay down long or drop more sharply than you think, right? I wouldn't say they stay down longer than you think now, because when you look at those 5 instances that you just highlighted, Gary, let's look at the last 3. So 2000 to 2003, that was a brutal, painful, long sell-off that took years, not months, right? But then in
14,
0809,
I believe.
yeah, 0809 it took 9 months. So much more compressed time period. 2020 and the pandemic, it was less than 2 months. Things are happening much more quickly because you have algorithmic buying and selling in 2020. That didn't exist in 2000, right? Like, you're going to see things drop faster than you expect. And I think one of the biggest problems that has been talked about on many shows like yours is the Mag 7 is driving performance within the S&P 500. So when you look at your S&P 500 return on your 401k statement, you're very excited about what happened in 2024. But then you take a deeper look and you realize that 7 of those 500 stocks added most of the alpha to that return. And you have to be wondering what happens in a sell-off if every mutual fund, Vanguard, Fidelity, BlackRock, all own the same stuff.
Exactly.
I can look at 0809, Washington Mutual, Citibank. This is what happened. Like, they all owned the same.
I don't mean to interrupt, but now, of course, this has been being said for the last 2 to 3 years.
Very true. And I've said it too, by the way. Like, I've been wrong about this just continuing as it has. But every quarter that you keep going where things just are like a party-like environment, it ups the ante to a larger sell-off. So instead of a 8 to 10% correction, I'm expecting more of like a 12 to 15% correction minimum, and a 20% correction on stuff like the S&P is considered, a major correction. So I think that's on the table for 2025.
Okay, so John, earlier you brought up NVIDIA. Their market cap is currently 11.7% of U.S. GDP. It's more than double the market cap of Cisco at its peak during the dot-com bubble, which was 5.5% of U.S. GDP. Is their CEO, Jensen Huang, is he the most important person in 2025 for everyone's investment returns? I mean, given the unprecedented concentration in stocks that you just talked about, isn't it so goes NVIDIA, so goes your year?
Um, it really is those seven stocks to me because, again, like a Fidelity, a Vanguard, a BlackRock, these were all very successful institutions in 08, 09, right? They were. But now they're much, much more successful. So the assets that they're managing are much, much greater. And so the sell off will feel way worse, I think, in 2025 or 2026 than it did in 08, 09 because you've got a lot more people gambling in the stock market now, right? This is more like a casino like environment than an investing environment to me.
So if we do have the sharp sell off like you're, envisioning, is there a point, is it 10%, 15, 20% in this compressed period of time where you believe, okay, the Fed's going to step in? They have to.
Yeah, I mean, they're telegraphing two 25 basis point cuts in 2025 as we sit here right now. Um, let's just see how things unfold. I mean, inflation is going to be big for them, right? CPI. I don't believe CPI is headed in the direction they want. I mean, it got close to 2%, barely, if you want to be like fair about it. And then it just went the other way, right? So, like, I think Trump is going to be inflationary for the U.S. market, and that is something that is sort of helping gold right now. I believe, right as we speak, that that 26-29 an ounce resistance kind of flipped to support this week, which is really bullish for gold if it holds, because you'll take another run at 2,800 at some point next year, or excuse me, later this year. And then I think that big round number 3,000 is going to get hit this year, which would imply a nice return here from 26.25 or 26.10.
Yeah, there's a lot of folks in your camp. I saw an image today online. There was about 20 to 25 different analysts and banks, and 75% of them are predicting 3,000 plus for this year. So speaking of gold, it got off to the great start in 2024 around March. And except for the last 2 months, it continued rising throughout the year, though with high volatility. The net result, the metal ended the year at around 2,600 per ounce, up 26%. That was the best performance since 2010. What are you expecting? Are we seeing another 26%? Are we seeing 10%? What are you envisioning this year for gold?
We don't look out a year on anything. I don't think in this market you really can. I would say that we'll touch 3,000 this year, which would imply, what is that, a 10%, kind of a 10-12% kind of return on gold, at least touching 3,000. That's not really exciting to me as a portfolio manager. I want to make a lot more money than that, right? So, like, I'm telling people, you have to look at gold stocks right now. There's three types of mining stocks, right? There's producers, there's developers, and there's explorers. And we own all three types of gold stocks. Ones that are nearing production, like Denarius Metals, DNRSF. You have to buy a stock like that here at 44 cents and hold your nose. Like, I mean, that's going to go into production this quarter. So, I believe guys like Serafino are going to get it done because of 20 years experience at a company like Eris, right? Where he killed it there in the same country. You look for these kind of opportunities and say, why is this stock so undervalued? It's because people, because of Victoria Gold and other things that didn't go well, kind of wait to see how things start off, right? And then they buy. That's a mistake. You need to pick up the phone and talk to people like, Serafino or Mike at the company and say, tell me about your experience with mining in Colombia. Tell me about your overall experience. What hurdles have you faced in building this mine that you didn't think you were going to face? Are those overcomable? What kind of money do you need for this year, right? Like, these are just logical questions anyone can ask a CEO. But if they don't feel comfortable doing that, then partner with a service like ours that does that every single week.
So speaking of, I understand that you beat the GDX in 2024 by about 16%. What's your investment philosophy? How do how would you explain why your gains were so much better?
It's really that our first screen is people, Gary, like people that have experience. We rarely will buy anything with someone that has minimal experience at the helm. There's just too many things that can go wrong in mining. So even if the project is awesome and you have a really inexperienced CEO, we're just not interested. We gravitate towards 20 plus years of experience because those CEOs have seen cycles like we talked about, right? They've seen 2000 to 2008 to 2020, and they know how to manage capital through times like that if we run into another rough patch. So we split. We don't say, hey, we want this much gold exposure, this much silver, this much in critical minerals. We just look at the entire commodities universe and then try to find good companies within each of the metals. One of the themes that we played last year that helped our outperformance was critical minerals. I was part of the DC conference for critical minerals in April, and we had about 55 companies there that were from every walk of life, not just copper, uranium, like more mainstream, but tellurium, antimony, tungsten. And so when you get to know some of these stories, they can add a lot of value to your overall portfolio because they don't have analyst coverage, and the average person's totally confused when it comes to some of these metals and how they work, right? But just taking antimony for an example, Morgan Stanley wrote up antimony in April with Perpetua Resources, PPTA. And that to me was huge because coming from that world for 25 years, Morgan Stanley doesn't write up mining stocks much. So to me, that was like a big deal. And we got behind Perpetua there. That, helped our return. But also we looked at what other metals would be considered, really produced heavily in China, which is a country that, clearly Trump doesn't like. If Trump wins, this is going to be frictional for 2025 and beyond. And I think that's exactly the environment we're in right now. Something like tungsten was produced 91%, I think, in a combination of Russia and China last year. The U.S. produced 0% of tungsten. And what does tungsten do? Well, it's used in body armor. It's used in ammunition. It's used in things that, as we fight these wars or fund wars, tungsten is going to become much more critical as a mineral going forward. We think the Department of Defense is going to start recognizing this kind of thing. And if you don't believe me, look at Fireweed Metals News, FWEDF, on December 16th, just 2 weeks ago. They got a $35 million grant from the government to help fund efforts in a mine that has tungsten in it, right? So there's not a lot of these out there. And so free money is very, very good, right? It's non-dilutive to you and me as shareholders. And so we're looking for other companies like Guardian Metal Resources, GMTLF, Demesny, DEMRF. These are both U.S.-based tungsten plays. And we're saying, why wouldn't that, follow suit? If they're going to get a grant, why wouldn't these other companies get a grant? And if you talk to the CEOs at both of these companies, they're both saying, yeah, that's smart of you to think that way because we're in better jurisdictions than Canada in our view. We're in Idaho and Nevada, and Trump's going to have our back, right? This is the kind of environment we're moving into. So I think as an investor, you always have to think about, okay, if I made mistakes in the past, take a loss, right? Or get out flat and then put money into sectors like this that will actually have you, get a good return and make up for those losses.
That's really good advice. And there's a lot of interesting information you just shared there. Staying on the miners for one moment here. John, what is your view on why the miners can be making so much money, like the gold miners, and be so cheap at the same time?
That's a great question. If you look at the last couple of quarters, the big three within GDX, the big three holdings, are Newmont, NEM, Agnico, AEM, and Barrick, GOLD. If you look at the earnings of these companies over the last few quarters, they've been putting up some great free cash flow numbers. They're not yielding the best. Newmont's probably got the best yield of the three, but they're still paying some type of dividend. And I think that'll be more attractive as we move from a growth-oriented market to a value-oriented market. Value managers like to see coupons out there. They like to see some sort of yield associated with the stock they're buying. I think part of the problem, Gary, is that, energy costs are, if you're a producer, are, how much is diesel going to cost in a Trump presidency, right? That's a concern. Diesel is going up, oil is going up in our view. So as you're producing, your costs are going up too. So let's say your costs are going up and gold levels off here at 2,600 and drops to say 2,300. Well, that 10% haircut in the price is going to, decrease your profit margins because these companies are producing gold at between 14 and 16.50 an ounce, right? So very healthy margins as we sit here right now. But if energy prices go up and gold prices go down, then you've got a bit of a problem. And I think the market is kind of handicapping that, which I think isn't a concern, because I see, like you said, like most banks, that gold is going to 3,000 at some point next year, and these margins are going to get better, not worse.
So in essence, it sounds like you're saying, and I'm not saying you believe it 100%, but you're saying that the market is essentially saying they don't believe the higher gold price and the lower oil price. They believe the oil is going to go higher and gold's coming down some. So margins are going to compress.
Right. Right. And if you don't believe me, look at Newmont's last quarters. Their costs are continuing to go up. That's why the stock can't catch a bid, is that their AISC, their all-in sustaining cost right now per ounce, is around 16.50, which is quite high for a major. And the market wants to see 14 to 1,500. I think they're.
But you believe it's actually going to go in the opposite direction. That the margins are, even though the market currently is believing in compressing margins, it's actually going to expand.
Yeah, I mean, like, if they don't get to 14 or 1,500 an ounce, what's going to help them is the higher gold price, right? So, like, if gold goes from 26 to 200 to 3,000, then they're still, even at 16.50, going to make a much larger margin per ounce than they are right now. And so I just don't see oil like running out of control like some people do. I think it will head higher, but I don't think that's going to cut into earnings as much as people think.
So UBS Bank recently put out a report on silver that they have a very bullish outlook. They're saying $38 per ounce by the end of the year. Is that in line with your analysis?
Yeah, so your major resistance points on silver are obviously 30. 30 was 11 years resistance. We're right under 30 right now. I think we'll break through that literally this month. 32 to 33, which has been problematic for silver last year. 35, which was obviously the big line in the sand last year. And then 38. So we see those as sort of, rather than saying we think this is going to happen, we always give investors like resistance levels so that they can kind of look at things and not get frustrated, right? Getting derailed in this sector is super easy. So you have to look at it and say, okay, great. We took at that first resistance point. John was talking about 30. Now let's focus on 32, 33. If 32 to 33 breaks, you're going to test 35 again, which it did last year. It ran up to 34 to 35 and failed. So that's really what my eyes are on more than 38, because there's not a ton of resistance, Gary, between 35 and 50, really. Historically, we've hit $50 an ounce twice in history. So I think you can make another run at 50 over the next 12 to 18 months, which would mean these silver equities are going to fly.
So as long as it busts through the 35 resistance level.
Yeah, 35 is, making a higher high than 2024 would be very bullish for the metal.
Okay. So, John, you talked about uranium before earlier. There's been incredible amounts of bullish news over the last 12 to 18 months. I can go through it's a litany of it. But why haven't these catalysts really had an immediate positive impact on uranium stock prices and uranium prices in general? And do you see the most recent news from the other day of the split between Kazatomprom and Cameco over a joint venture that they had being kind of like a Cigar Lake moment where we could see a significant price surge here in the metal and the equities moving forward?
So this time last year, I was at VRIC in Vancouver, and I met with probably 7 or 8 different uranium CEOs in 3 days, and the sentiment was so good, and it is now so bad from those same people. So that should tell you something about mining. Again, if you don't have the stomach to last in sectors like uranium, you should probably invest in something else. It's very difficult. That said, uranium is going to have a really good couple of years. Whether it's this year, I don't know. I think that the price getting above $100 last year was extremely bullish. We saw a lot of the juniors explode on that. The majors did really, really well. But interestingly, the majors, meaning like Cameco, like you mentioned, CCJ, Denison, DNN, they all did really well even later in the year and made higher highs in some cases. So that's really bullish. So if you wanted to play the big cap stuff, which has been working in my opinion, then you buy URA, which is an ETF out there you can purchase that encompasses, like GDX, a lot of the larger uranium stocks. But we play a lot in the small stuff because the small stuff has literally been thrown out the window like it's never going to work again. And that's just completely ridiculous, right? I mean, if you believe in uranium in general, you have to believe in the small guys that are going to be gobbled up by the big guys. So you saw Peninsula Energy just went into production in December last month. It's in Wyoming. It's not in the Congo, right? Like, this is Wyoming. Like, these guys have done a good job of getting to production, and yet the market doesn't even care. It's unbelievable. Forum Energy, I talked to Rick Mazer, who's been doing uranium for 41 years, and we were talking about this rookie trader that was blowing his stock out from 4.5 cents down to 3 cents in one trade in less than 1 minute. And I said, 3 million shares crossed the tape. What the heck happened? And Rick was like, look, we'll find out. And he did find out who it was. And, it was a one-time event during tax loss season. So thank God we were on the bid at 3 cents. One of the other things, Gary, to answer your question about what we do is we don't enter one buy order. We enter two at least all the time. One is going to be closer to the action. One is going to be away from the action, like that was, in case something crazy happens like that, so we can capture that upside. And now the stock's at 0.043. It's like up over 50% or about 50% from that, which was less than a month ago. So the volatility in these things are astronomical, and I think that the real upside is buying the small and mid-tier stuff right now. The big stuff is going to make you money. Like, we still own Denison and some other names, but I think that the real big money is going to be made in the small stuff as we move forward.
Well, this has been a fantastic conversation. Before we wrap up here, and I asked John the final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. It's a free gift, and it's a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, positive, you've enjoyed the conversation with John as much as I have, please let him know. Hit the like and subscribe button and leave a comment below the video. All right, John, it's time for a lightning round moment here. Okay. I'm going to ask you to rank a few assets as a buy or a sell by you giving it a score of 1 to 100, with 100 being an extreme buy and 1 being an extreme sell, and then giving just one sentence as to why you take that position. Okay. You ready?
Yeah, just in full disclosure, though, I'm not licensed anymore, so saying buy and sell is a little rough for me. I'll just give a number. And happy to add some sentences or questions afterwards.
Yeah, 1 to 100. Just for reference for those listening, 100 would be, that's something I would definitely buy. All right, so on a scale 1 to 100, gold.
For next year?
For 2025.
Yeah, so I'd say a 90.
Okay, and why do you take that position?
Just a lot of uncertainty in 2025 and a great 2024 technically that it's building off
of. Silver.
Silver's 95. The gold to silver ratio right now, which is dividing an ounce of gold by an ounce of silver, is literally at 90. If you go back to 1980 and look, gold to silver ratio, every time it hits 90 is a buy every single time except 2 times since 1980.
Copper.
Oh, man. I want to give it a higher grade, but I'm going to say 60 because I have to see the price action to believe in it, because I see the big institutions loving it, and I'm not seeing it in the price action
yet. Do you have any speculation as to why?
I mean, I think China, and the U.S. are going to duke it out this year. So I don't know how that ends for China, and China is the biggest consumer of copper. So that's weighing on people's minds, I think, for now.
And uranium.
Uranium, I'd say like a 75 to 80. And I think, again, building on a really good looking chart for the uranium price, equities will catch up.
Well, I want to have you back on where we can go deeper into some of these individual equities. But John, thank you for coming on to Metals and Miners and for being so generous with your time, your analysis, and ideas. It's really been a lot of fun to spend the time with you. Would you please summarize your views that you covered today and let those know that are tuning in where they could learn more about your work and how they can connect directly with you?
Yeah. So I'm an independent thinker. We don't, as you can tell, buy stuff that has a ton of analyst coverage. I think that's where you make the most of your money. We as I mentioned, buy all types of stocks in the commodity space. We buy the producers, we buy the developers, we buy the explorers. We also buy royalties. We don't discriminate. So we're buying a bunch of different things, and that appeals to a lot of investors because not all investors want to buy just one type of anything. So the name of the game for us is making clients money. If you can make money, I think people will continue to follow you. If you're underperforming, they won't. And so, we grind every single day to try to make performance happen in the portfolio. People can find our performance. We're very transparent with it for the last 9+ years on feneckconsulting.com. We'll have our 10-year history December 31st of this year, and we're very pleased about that. It's been a grind, but I think that when that number comes out, we'll be top decile probably globally. And to get there makes me feel really good.
That's wonderful. John, I've been following you for a couple of years, and so I really appreciate you coming on here. I look forward to having you back on sometime soon. Everybody, if you're not following John, you got to follow John. Go check out his website, check out his work, dig under the covers there, under the hood, have a look, and I'm sure you're going to enjoy what you see there. So thank you for being here with us, and everybody else, thank you for watching. I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. It's a free gift, and it's a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.